I am DeAnna Lee. I am the founder of Collective Destinations. Thank you so much for joining. I'm excited to be here. So the purpose of this webinar is to connect with like-minded people just like you and share an opportunity that I think is amazing. And I think you will too. So for the last few months, I've been offering this webinar every week. And in that time, we've brought on some pretty great investors and also created a Facebook community for people just like you who either want to be involved or maybe just want to learn as much as possible from the sidelines. And no matter where you are in the process, I'm here to offer value every week. So if you haven't already, be sure to join our Facebook group. This is a place to ask your questions, and every Friday I will answer them live right here. So this community has inspired me to add some educational pieces into the weekly webinars as well. So this week we created a poll and let our members determine what we would discuss today. From the ideas in the poll were how do we find our properties, to determining the best places to buy, the strategies we use to increase occupancy and revenue, or how do I determine the numbers? The last one was our winner. And it is important to know the numbers on a deal. So today we will take a deep dive into how to tell if a deal is a good deal or not. I'll start by explaining the most common and necessary metrics needed for understanding this. There are so many acronyms out there that it is really easy to feel overwhelmed. I will tell you what they are. I'll give you the formulas and explain what they mean. So be sure to have a notebook handy, write down your questions, calculate the formulas, and feel free to ask questions during the presentation. Since you're live here, you get the opportunity to get your answers from me right on the spot. So ask questions if it doesn't make sense, if you want to pause me during the presentation, no problem at all. Or just wait till the end and we'll do a Q&A. So after the intro on numbers, we will go through the presentation. And even if you watch the video, be sure to stick around until the end where we will take the actual numbers from this deal. We'll put them into the formulas together, and you can determine for yourselves if this is a good deal or not. There are so many formulas. Where do we start? We have cap rates, NOI, IRR, ROR, ROR, and CAGR, to name a few. Right? What's the ROR? The rate of return. How do I determine it? By knowing the CAGR. What is a CAGR? Compounded annual growth rate. Ending value by value, beginning value raised to 1 to the nth number of years and 100 to get to 100%. Seriously, guys, this makes me want to take a nap, but I've got you. So basically this converts your beginning value and your ending value and converts it to a percentage. So I don't know about you, but yeah, like I said, at this point, I was thinking I need a nap. So in more serious note though, why do we need these? What is the benefit? With these tools, we can remove the emotions from an opportunity and determine that this really is an opportunity you want to be a part of. So these metrics, these are dials we can play with to optimize values and cash flows in order to reposition the properties in the marketplace so everyone wins. There are many methods for determining value. You have replacement costs, which, you know, if the places were to burn down, what would it cost us to rebuild them? This is very helpful if you're doing an insurance evaluation. You have comparable sales. Those are things that you see often when you're working with a real estate on a retail deal, working with a realtor on a retail deal, and you look at similar properties that have sold in the area similar to yours. And then also the gross rent multiplier, which it's useful for a quick and dirty comparison of properties, but it's not very accurate because it doesn't account for things like operating expenses. And then there's the income approach, which is where the cap rates come in. In the past, you guys, I have shied away from talking about cap rates because they are difficult to explain and to understand, but it is important. So I figured out how, and I will explain what I can. So please keep in mind, I am not a financial advisor. I'm not a CPA or any other financial professional. So when deciding to invest, you must do your own research. However, I am a real estate investor with a lot of experience and a solid track record. So let's do this. Cap rate. Cap rate stands for capitalization rate. Capitalization. This is your money in the deal, and rate is a rate on your money. So simply explained, the cap rate is a return on investment after operating expenses if you paid all cash. So this evens the playing field, right? If someone has better financing terms than another one, they might make more money, but the performance is still the performance. The value doesn't change. And so because of this, it is better to compare cap rates than cash flow. Does that make sense? So this is why cap rates are useful. The formula for determining a cap rate is cap equals NOI divided by purchase price or value. And there we go again. There's another one of those acronyms, NOI, right? So as long as you have two of these figures, you can determine the rest. So you may be asking, what is NOI? I don't know what stage people's are in the investment process, so bear with me. I'm going to go get down and dirty on this one. So what is an NOI? This is a fancy way of saying profits. It's your net operating income. It's income received after operating expenses. For example, easy numbers. You purchase a property for $1 million and your net operating expenses are $100,000. So you have a 10 cap. Simply stated, a return on investment would be 10%. This is your ROI, your return on investment. Now you guys don't have to write really, I know I talk fast, so if you're trying to keep up or write these things down, Kathy is putting all of these formulas in the chat and explaining the acronyms, so you can listen and then go to the chat and copy and paste. So we do need to also know what the formula for ROI is, right? So return on investment equals the gain on investment minus the cost of the investment divided by the cost of the investment. Confusing, right? Simply stated, it is the net profits divided by the purchase price. Are you starting to see a similarity? As I would dive deeper and deeper into these numbers, I realized there were so many different terms for basically the same things. So instead of getting overwhelmed, pick your favorite ones and just work there, and then start adding in the others, and you'll start to see the similarities. Like, oh, this pretty much gives me the same thing, but this was the value and this was the purchase price. Could be the same, right? So, well, what if you don't know the cap rate? You start with the beginning value and the market cap rate. Now, you guys, this takes research. If you're just getting started, or maybe you've been in this for quite some time, I recommend starting a scorecard. This is for you. This is to keep track of your research. You're going to have to, if you're wanting to do this on your own, you're going to have to start analyzing a lot of deals, even if you don't purchase them. Watch those, see what they sold for, add it to your scorecard. And over time, you'll be able to know with confidence what a good cap rate is for your desired asset class. I personally recommend partnering with someone like myself who has done this for many years and understands this asset class really well. So another question, what if I don't know the NOI, right? The net operating income. You have many sites. There's a site called Rabu, AirDNA. These can help you determine incomes for specific properties in different areas. And there are best practices for determining expense ratios as well. So as a general rule, just starting out, your expenses could be 65 to 85% of your profits. I don't think that they talk about that anywhere. There's so many sites on YouTube University, right, where you get on there and they say, I made $100,000 on one property in my very first year. And they might have, but what they forget to talk about, they probably did, what they forget to talk about is that they spent $65,000 to $85,000 in operating costs and all the systems that you need. And at the end of the day, if you have debt on the property, the debt service will then take more of your profits. And hopefully you are left with a little bit at the end of the year. And this is why smaller Airbnb single property owners, guys, they're struggling. You see it all the time, again, probably on YouTube, like, oh, Airbnb fire, this is, it's falling apart. And it's not falling apart. It's just what happened was everybody said, oh, this sounds like a great idea. I'm going to buy a property, put it on Airbnb and make a ton of money and not have to do much of anything. And you guys, that was the story for about 2 years. Now, I've been doing this quite a bit longer than those 2 years, but in 2020 to 2022, you really could. You could just take a property, put it on Airbnb and make a lot of money on it. But that's not reality, you guys. Getting started out, you're going to have a 65 to 85% expense. I just lost the word, operating expenses. So this is why I created Collective Destinations. It takes all the same systems for property management software, automation, marketing, operations, and so many more. I have a quadrants of the vacation rentals that has 3 pages of all of the different systems and processes that you need to have in place to have a vacation rental or short-term rental business. I'm happy to share that too. If you just want to put in the chat quadrants, then Kathy can send that out to you. So I want to make sure that you guys are leaving with value. So those are all the things that it takes just to run the thing. So, but what I realized was it takes the same whether you own 1 property or you own 10 or 20 or 100. Of course, we need on-site operations in every location. But other than that, the overarching view, you just need 1 CPA, you just need 1 attorney, right? All those things cost the same whether you have 1 property or 100. So let's keep going. So if we can increase income and decrease, start over. If we can increase income and decrease, I can't say that word, decrease expenses by scaling our operations, we win. Okay, so how do we predict value using the cap rates? If you can increase the NOI even a little bit, remember what NOI was? The net operating income. If you can increase that even a little bit, you get an exponential increase in value. So we force the appreciation by decreasing expenses and increasing our income. Now, cap rate is also a measure of risk. And so we mitigate risk by purchasing in different markets across different economies. The higher the cap rate could mean the higher the risk. So we invest at a lower cap, we get the expenses right, we future pace and diversify our portfolio in up and coming areas. For example, you buy at a 6% cap, you increase income effectively and it becomes a 9 cap. So how do we do this? We'll discuss these strategies in a minute. So what we want is something intuitive, quick, and simple. Cap rate is not specifically a return, it is an income approach to value. And this is a magical formula I resisted for many years until I understood it. And you guys, knowledge is power. With this knowledge, we know we can do the following. We raise the net operating income to raise the value. And like magic, the investor can make extraordinary returns. Would you like me to show you how? So this is your time to dream, to really envision what this could mean for you and your family. You guys, you have to be brave enough to dream the dream. Is that you? I think so, or you wouldn't be here today. Something inspired you to say yes to the webinar.